Hi guys, welcome to CA Inter Financial Management. We are doing a chapter called as leverage. Leverage means risk. Obviously, there is risk in everyday life. You as students who are doing CA, there is a risk. You all know what is the risk, right? But then we take huge risks because we want to be getting higher returns. There is no returns without risk. And this chapter teaches you how to numerically measure your risk. In a business also, there are many types of risks that come, but then one common thing. Risk comes because of fixed costs. Because whether you have profits or not, fixed costs will have to be met. And there are two types of fixed costs. You all have operating fixed costs like salary, like rentals, okay. These give rise to operating leverage. And then there are financial fixed costs like interest and preference dividend. These give rise to something called as financial leverage, and the combination of them, okay, which measures the impact of the operating fixed costs and financial fixed costs is going to be called as combined leverage. Leverage means risk. Today's question is all about that. Before I start, just one thing, all our costing lectures are coming free on YouTube every Saturday, Sunday. Do ensure to check them out. We not only give the lectures, we give completely free soft copy. We give summary of each and every question that we all do. So therefore, on the last, you can only read the summary and try to be going ahead. There are tests at the end of every chapter. There is a dedicated homework section which takes care of all the things. RTPs, everything is being put on YouTube. So therefore, a student will not have to be paying a penny also for all these things. Let's start off with today's question. So, if EBIT is 15 lakhs, interest is 2.5 lakhs, corporate tax rate is 40%, degree of financial leverage is, bring me the four options please. 1:11, okay, 1.2, okay, 1.31, and lastly 1.41, okay. Now, before we all try to pick up our calci and solve it, in case you all know, please do that at this time, okay. In case you all know this thing, then please comment the correct answer below. So let's move on. See, financial leverage. Financial leverage measures financial risk. Financial risk arises due to financial fixed costs. Financial fixed costs are of two types. You have interest, whether you have profits or not, you will be paying interest. And you have preference dividend. In case you have profits, then you have to be paying the preference dividend. They are called preference dividend because they have preference over the equity dividend. Okay. So, the risk that comes due to these kind of fixed costs is going to be called as financial risk or financial leverage. In this question, there is no preference dividend, so I'll skip that part. Okay, but a universal formula of leverage is defined as percentage change in dependent variable divided by percentage change in independent variable. So, before interest, what comes is EBIT. That is going to be an independent variable. And after interest, whatever comes will be your dependent variable. So, therefore, the formula becomes percentage change in EPS divided by percentage change in EBIT. Instead of EPS, you can be taking PAT also. Instead of PAT, you can be taking EBT also. Okay, because percentage change in all these will always be same unless or until there is preference dividend. Okay. Now, this formula is the original formula. How leverage comes, how we have started away with the things in your lectures. But then in this case, this formula can be converted into slightly a shorter version. I'll not try to be explaining the conversion now, but just I'm going through that. So therefore, this can alternately be written as EBIT upon EBT. So above formula gets converted into this formula. Okay, EBIT upon EBT. Now, let's talk of this entire question. Okay, so therefore, EBIT in this case was 15 lakhs. Interest was given to you as 2.5 lakhs. EBT will be 12.5 lakhs. Further things, to be very honest, I do not require, but just for time pass, you all have your tax at the rate of 40%, and finally PAT comes. Now, pick up your calcies. FL, financial leverage, is nothing but EBIT upon EBT. So, 15 lakhs upon 12.5 lakhs. That should be 1.2. So, as per me, that should be the correct answer. Yeah, that is the correct answer. I'm done for today. I'll see you all next time in another MCQ. Till then, take care of yourself. Bye and happy learning.